Imagine you're running a huge global energy company. I mean, how do you keep it moving forward, growing, delivering value when the markets are just constantly shifting? It's a real challenge. Well, today we're taking a deep dive into exactly that. We're looking at the latest moves, the financial performance of ConocoPhillips. They're one of the world's biggest oil and gas exploration and production companies. So this deep dive, it's all about their second quarter 2025 results, the financials, but also the big strategic moves they've been making. We're basing this on their official Q2 results announcement. That's Exhibit 99.1 if you want the specifics, and also their detailed 10Q filing with the SEC that covers everything up to June 30, 2025. Our mission here is pretty simple. Unpack the key numbers, understand those big strategic shifts, and just see how a major player like ConocoPhillips is involved navigating this volatile market. We want to help you get informed quickly, thoroughly, with the important bits pulled out for you. Okay, let's get into it then. When we look at ConocoPhillips' second quarter, what are the sort of big headlines financially? What jumps out?
Well, for Q2 2025, they reported earnings per share of $1.56, and adjusted earnings per share came in at $1.42. That adjusted number, that usually gives you a cleaner look at the core business, right? Strips out the one-off things.
Exactly. It's often a better measure of ongoing operational performance.
Right. Now, it is true, this is down compared to last year, Q2 2024. Back then, both numbers, reported and adjusted EPS, were $1.98. But, and this is the interesting part, despite that dip in earnings, they still showed really strong cash generation. $3.5 billion from operating activities and $4.7 billion in cash from operations, or CFO. If you exclude the working capital changes, that's a lot of cash.
That's substantial cash flow.
And they also declared their third quarter dividend, 78 cents per share. So, okay, earnings are down year over year, but the cash flow engine is clearly firing on all cylinders. How does a company this big manage that? Generate that cash, keep returning it to shareholders, even with lower earnings? What's the secret sauce there?
That's a really crucial question. And, you know, it's not just that they made cash, but how they managed it. It really points to their operational efficiency, their disciplined capital allocation. It shows their business model can flex, you know, even in these volatile markets. And that resilience, that's key for any company in a cyclical industry like energy. It ties right into their core strategy. They call it their triple mandate.
Triple mandate, okay.
Yeah, it means first, responsibly meeting global energy demand. Second, delivering competitive returns, both on and of capital. And third, working towards their climate goals, their emissions targets. And underpinning all that are some foundational principles. Balance sheet strength, number one. Peer-leading distributions, giving cash back to shareholders. Disciplined investments. And responsible ESG performance.
Okay, so that mandate translates into action, you're saying. How so?
Well, look at the shareholder returns. In Q2 alone, they distributed $2.2 billion.
Wow, $2.2 billion in just one quarter.
Yeah. And that was split between $1.2 billion in share buybacks and $1.0 billion through that ordinary dividend we mentioned. And think about the bigger picture on buybacks. Since 2016, they've repurchased a total of $37 billion worth of shares.
$37 billion.
And last October, the board okayed raising the total share repurchase authorization up to $65 billion. That's a huge commitment to returning capital.
It certainly signals confidence.
Yeah.
What about the balance sheet strength you mentioned?
Right. So they ended the quarter with $5.7 billion in cash and short-term investments, plus another $1.1 billion in long-term investments.
Okay.
Add to that an available $5.5 billion they can borrow under their credit facility, and their total liquidity, the financial flexibility, basically was almost $11 billion.
That's a pretty solid war chest.
It is. And what's more, their total debt actually went down slightly. It was $24.3 billion at the end of 2024. Now it's $23.5 billion. And the credit rating agencies, Fitch, S&P, Moody's, they all have a stable outlook on the company. So yeah, it paints a picture of a very financially solid operation.
Okay, so financially sound, generating serious cash, returning value. Got it. But beyond the numbers, ConocoPhillips has been making some really big strategic moves lately. What's the story with that huge Marathon Oil acquisition and also these aggressive asset sales they're doing?
Yeah, this is where it gets really interesting. And what's fascinating is the sheer speed and scale of how they're executing this strategy.
Yeah.
Take the Marathon Oil acquisition, completed last November, valued at $16.5 billion. They're already seeing significant results.
Already.
Yes, they're on track for over $1 billion in synergies. Those are cost savings from combining the companies on a run rate basis by the end of this year, 2025. And on top of that, another $1 billion plus in one-time benefits.
Hitting $1 billion in annual savings that quickly after such a big deal?
That's
It
fast.
really is. It suggests they have a very effective integration process, which is frankly a huge advantage in this industry. Big M&A deals are notoriously tough to get right.
So they're not just buying, they're digesting quickly and efficiently.
Exactly. Extracting value. And they're not stopping there either. They've also announced more cost cuts and margin improvements across the whole company. Another billion plus expected on a run rate basis by the end of 2026.
Wow. So they're really focused on getting lean after the acquisition.
Relentlessly focused on efficiency, yes. Now, turning to the portfolio optimization, their asset sales strategy has been pretty successful too. They just signed a deal to sell assets in the Anadarko Basin for $1.3 billion, expected to close later this year, Q4.
Okay.
And that sale alone means they've already blown past their initial $2 billion target for asset sales and ahead of schedule.
So they hit their target early.
Right. And now, signaling they're going to keep optimizing, they've actually increased that target, now aiming for $5 billion in dispositions by the end of 2026. Selling off stuff that's not core to their strategy.
Makes sense. Keep the best bits, sell the rest.
Pretty much. And through the first half of this year, they'd already completed sales of about $1.3 billion, including selling their stakes in the Ursa and Europa fields for around $700 million. And beyond these portfolio moves, they're also pushing forward with their global LNG strategy that's liquefied natural gas.
Yes, LNG is a big topic.
It is. They've signed a regasification agreement that's for turning LNG back into gas at the Dunkirk terminal in France, and also a sales agreement in Asia. Both are set to start in 2028.
So that's a longer-term play, looking out several years.
Absolutely. It shows they're positioning themselves strategically in the global energy markets for the long haul, not just focused on immediate production.
Okay, let's talk about that production then. The energy market is, well, it's famous for its ups and downs, a real roller coaster on prices. How did ConocoPhillips actually perform operationally, especially, balancing production volumes against those price swings?
Right. If you step back and look at the big picture, there's a pretty clear story. They had significant production growth, and that growth helped offset, at least partly, the hit from falling crude oil prices. At the same time, rising natural gas prices actually provided a bit of a tailwind for them.
Okay, so a mixed bag on prices, but production was up.
Way up. Total company production for Q2 was 2,391,000 barrels of oil equivalent per day. Let's call it MBOD for short.
2,391 MBOD.
Yeah, that's a huge 23% increase from the same time last year. An extra 446 MBOD.
Where'd that growth come from?
A lot of it was from their lower 48 operations. That segment produced 1,508 MBOED. Key areas there were the Permian Basin, that was 845 MBOD, the Eagle Ford at 408 MBOD, and the Bakken at 2 and 5 MBOD. Primarily, these increases came from new wells starting up across lots of regions, lower 48, Alaska, Australia, Canada, China, Libya, Norway, and of course the big impact from adding Marathon Oil's production.
Makes sense.
Now, these gains were offset a bit by normal field decline, which always happens, and also some planned maintenance shutdowns or turnarounds they had in Norway and Qatar, but overall a big jump in volume.
Okay, so volume up. What about those prices you mentioned?
Yeah, prices were definitely a headwind, especially for oil. Their total average realized price across everything, oil, gas, liquids, was $45.77 per barrel of oil equivalent, or BOE.
$45.77 per BOE.
Which was 19% lower than the $56.56 they got in Q2 of 2024.
Ouch. What drove that?
Mostly crude oil. Brent crude averaged around $67.82 a barrel. That's down 20% from last year. And WTI, the U.S. benchmark, averaged about $63.74, down 21%.
Why the drop in oil prices?
Main reasons cited were higher global oil supplies kind of outpacing demand, coupled with maybe slower global economic growth and therefore slower oil demand growth.
Okay, but you said natural gas was different.
Completely different story for U.S. natural gas. Henry Hub prices averaged $3.44 per MMBTU. That's up an impressive 82% from Q2 last year.
82% increase. Wow.
Yeah, driven by stronger demand and lower inventory levels compared to the previous year. Bitumen prices, though, were down 28%, although that was softened a bit because they could get better prices, better differentials, thanks to more pipeline capacity coming online with the Trans Mountain expansion.
So higher production helped, but lower oil prices hurt. How did that net out for earnings?
Well, exactly as you'd expect. While the higher volumes were a definite positive, the big drop in crude prices, combined with some other factors like increased depreciation costs, DD&A, and higher operating costs, largely because of integrating Marathon Oil.
Right. Integration costs money.
It does. So all that together led to the decrease in overall earnings compared to the prior year. It's a classic case study, really, of how even strong operations can be hit by commodity price swings. And it played out differently across their business segments. For instance, the lower 48 segment actually saw increased earnings, mainly thanks to adding Marathon and a gain from an asset sale.
Yeah.
But other segments like Alaska, Canada, and Asia Pacific faced earnings decreases, mostly due to those lower realized prices, or in some cases, higher exploration costs, like writing off an unsuccessful well in Asia Pacific.
Okay, so we've looked at the current performance, the strategic chess moves. What does this all mean looking ahead? What's on the horizon for ConocoPhillips? And are there any big external factors we should be watching?
Good question. Looking forward, their production outlook seems pretty solid. The guidance for the full year is holding steady, even after accounting for those asset sales they've announced.
Holding steady even with selling assets. How does that work?
It suggests the remaining assets, especially with the Marathon contribution and ongoing drilling, are productive enough to offset the sales. So for Q3, they expect production between 2.33 and 2.37 million barrels of oil equivalent per day. And the full-year guidance is also in that range, 2.35 to 2.37 MMBUED. The midpoint hasn't changed, which, as you say, is notable given the portfolio changes.
Okay, what about external factors? Anything major?
Well, there is one potentially significant thing: taxes. There was a new law signed recently, on July 4th, called the One Big Beautiful Bill Act, or OBBA.
One big, beautiful bill act.
Seriously. Politics aside, the company is still reviewing it, but they anticipate it could result in a pretty significant cash tax benefit for the full year 2025. Around $500 million.
$500 million benefit. How?
Primarily from accelerated tax depreciation. Basically, the new law lets them write off the cost of their investments faster for tax purposes, which lowers their taxable income in the near term and thus their cash tax payments.
Interesting. While that sounds like, a clear win for the company financially, does the name of that bill, or just generally getting tax benefits like that, ever create sort of public perception issues for big energy companies?
That's a fair point. Companies certainly have to navigate public opinion alongside these kinds of legislative changes. It's part of the landscape, especially in the energy sector. But focusing back on their operations, they are continuing to invest heavily in the business. They reinvested $3.3 billion in Q2.
Okay.
And it's worth noting that over half of that spending is going into those flexible, short-cycle, unconventional plays in the lower 48.
The ones that can ramp up or down relatively quickly.
Exactly. It gives them flexibility to respond to market conditions. Now, it's not all smooth sailing, of course. Like any major energy company, they face ongoing challenges, legal issues, potential liabilities.
Such as that has.
While there are various things mentioned in their filings, for example, they're still trying vigorously to collect on that huge $8.5 billion arbitration award against Venezuela related to expropriated assets. They have collected some money, about $791 million from a related award, but the big one is still outstanding. Then there are ongoing climate change lawsuits that various states and municipalities have filed. ConocoPhillips views these as meritless and is defending against them strongly.
Right, those have been ongoing for a while now.
They have. There are also claims related to coastal erosion in Louisiana and an order from the U.S. Bureau of Safety and Environmental Enforcement about decommissioning some older legacy assets in the Gulf of Mexico. So plenty to manage on the legal and regulatory front.
Okay. So wrapping this up, we've seen ConocoPhillips really skillfully integrating a major acquisition, optimizing its global portfolio with these targeted sales, and keeping its financial house in order with strong cash flow and shareholder returns. They seem very focused on balancing that strategic growth with operational efficiency, all while trying to navigate what is undeniably a complex and often turbulent global energy market. It really feels like they're playing a long game here.
I think that's right. And stepping back for just a second, you really see that defining tension of the modern energy sector playing out here. It's that constant pull between the drive for strong financial performance in a very cyclical commodity market, and on the other hand, the increasing societal and regulatory pressures around climate change and environmental responsibility. It's a real tightrope walk.
Definitely. So maybe a final thought for you, the listener. Consider how these strategic decisions ConocoPhillips is making today. Things like investing heavily in LNG for the future, while selling off other assets, while driving for these significant cost cuts. How will that position them for the next decade? What new opportunities might pop up, or what unexpected challenges might arise? As global energy demands keep evolving right alongside climate strategies, and potentially even more regulatory scrutiny. It's a fascinating puzzle, not just for them, but for the whole global energy picture.